Welcome to the S Corporation seminar. I have a client who is a personal trainer, a sole proprietor. As a consequence, all of his income is subject to self-employment tax. By becoming an S Corporation, he has payroll, which is subject to payroll tax. But by taking out some of his earnings as dividend-like distributions, he saves the self-employment tax on the part that isn't subject to the payroll tax, the distribution dividend-like thing. He saved about $3,295, we figured. That's enough for a nice lunch in Paris. If that didn't make sense, or you'd like a review of the basics, send me an email with your snail mail address, and I'll mail you the little box of ink free, while supplies last. As much as I like them, there are at least 4 situations when S corporations are not the right choice for clients. If your client can't keep books, or can't make payroll tax deposits on time, their being an S corporation is going to make things much worse for them. It costs money to get into a corporation, and it costs money to get out of a corporation. So if your client isn't sure they want to be in business, or they're not sure that they are in business, they probably shouldn't start an S corporation as the first thing. Although there are some tax savings associated with S corporations, there are also some costs. There is state corporate tax, and there's also the expense of doing payroll you may not have had to do before. My rule of thumb is that I want my clients to be netting between $30,000 and $40,000 a year before I let them be S corporations. I once heard that putting appreciating property into an S corporation was bad practice, and putting appreciating property into a C corporation is malpractice. This is because there's a layer of tax that comes with putting these appreciating properties into these type of entities that you may not want to pay. So, don't put your building into an S corporation is my general advice. If you're taking this class for CPE, this is the first line you'll fill in, either flakes, flirts, flops, or flyers. There are some upsides and some downsides to being an S corporation. The first is that your retirement contributions are limited by the wages, the amount that you're going to pay Social Security and Medicare tax on. The second is that you can save self-employment tax now. There's a minimum tax in California of $800 per year after the first year. You may have to start doing payroll, whereas you didn't do payroll before. This might be both an upside and a downside. It costs money to do payroll, certainly, but if clients are able to make their estimated payments via payroll tax withholdings, they might be a little bit better off. When you have an S corporation, you have to do an S corporation tax return. Although it appears this is only an upside for me, I suggest that the tax return actually comes out better because I have to do a balance sheet. My information is more accurate, more complete. Finally, a client needs to keep better books. I have to do that balance sheet after all. If they're keeping better books, they're more likely to know what's going on in their businesses. That's the intro. Now we're going to be looking at what are the problems and, more importantly, what do you do about them?